Good afternoon, everyone. Welcome to our webinar on Budget 2022, along with Roundup February 2022 edition. So, in today's webinar, we'll be discussing key indirect tax changes which have been proposed in yesterday's budget. I'm joined by my colleague Simran Arora, who will be taking part of the webinar. So, starting with the budget, the key highlights or the priorities which the government listed out yesterday were the theme of Sabka Prayas, ease of doing business 2.0. As India has completed 75 years of independence, so the next 25 years to 100 years is treated as a Amrit Kal, where a lot of development and similar initiatives will be taken. So from an indirect tax perspective, if we have to summarize the budget, has budget actually progressed towards ease of doing business? So our honest answer is no. There is no ease of doing business. This government repeatedly says that they believe in minimum government and maximum governance. We feel that at least from an indirect tax perspective, it's other way around. It's maximum government and minimum governance. And we'll be discussing, especially from a GST perspective, some of the changes which were proposed in the last GST Council meeting and made part of the law yesterday are very regressive, especially from an ITC perspective, which is backbone of GST. The government has made it almost impossible for taxpayers to do the compliances. So to that extent, these changes are not welcome. We'll be discussing all these in detail. So in nutshell, from a customs perspective, a lot of tariff simplification is done, and the government is gradually phasing out concessional duties, be it on raw materials, finished goods, capital goods, etc. There are both substantive and procedural changes which are happening. On GST side, the government considers that remarkable progress is being made, and the government treats the measure of this progress is how much revenues they are collecting month on month basis, which is increasing. But in our view, the true test for the progress is that how easy it is for the taxpayers to comply with GST law. Again, under GST law, a lot of substantive and compliance changes have been proposed. So starting with customs tariff proposals, one, as a part of this budget exercise, the government has issued a circular that there is an exemption from social welfare surcharge where customs duty is exempt. A very valid circular, and similar circulars have been issued in past as well in respect of education cess, etc. That if the base itself is zero, then all these cess or surcharge which are actually piggyback in the sense that these are calculated as a percentage of main tax. If the main tax itself is zero, then surcharge should also be zero. So to that extent, the circulars is right. But yes, there are a couple of adverse rulings like unicorn ruling for area-based exemption of Supreme Court. Similarly, Madras High Court ruling in case of Gemini Oil for BCD, which was paid through MEIS scripts. So to that extent, this is a welcome and correct circular and should put rest to disputes where a lot of exemptions are being availed, be it EPCG, be it advance authorization, free trade agreements, etc. So a positive move. Then a lot of exemptions, governments in its own wisdoms feels that these exemptions are not serving these purpose. So these will be gradually phased out. It is on the variety of products. So on an overall basis, phasing out of exemption seems a correct move, but at a ground reality, the government is not cognizant of fact that the very same goods, very same quantity, quality, etc., are these available in India or not? Secondly, by giving this excessive protection to domestic industry, will overall cost of the materials or procurements for businesses will increase or not? So this is a something to be watched out. Uh, Another important and we'll say a regressive move is that uh, on a lot of capital goods and especially project import scheme, the concessions have been done away with and they will attract 7.5% BCD. So project import was one of the popular scheme that a company who is setting up a plant, who does not have any exports, etc., who cannot import under EPCG, was entitled to import under concessional customs duty. So effectively, this scheme itself will become redundant now because even without this scheme, the rate of basic customs duty on capital goods is generally 7.5% only. On non-tariff side, firstly coming to the valuation, the government uh, has created a rule-making power where CBIC feels that undervaluation of goods is happening. So it can import additional obligations on importer. So very frankly, beyond this, nothing is there in the law as well as TRU circular. So we do not know which situations it seeks to cover, but the ambit seems very wide because the government in many cases, even if the goods are correctly valued, can believe that there is an undervaluation. And secondly, there's totally lack of clarity what sort of additional obligations will be imposed. So this is one of the change which needs to be washed out. Proper officer controversy which has been going on especially for last couple of years is whether DRI is a proper officer to issue show cause or not. And the background of this amendment is that the Supreme Court in case of Canon India, they held that DRI is not a proper officer. So in a situation where DRI has issued show cause notices, so such show cause notices are without jurisdiction and needs to be quashed. To overcome that, since inception of the Customs Act, the government has made retrospective amendments. They have made DRI audit and preventive officers as proper officers. The purpose is to overrule Canon India ruling, and they have given enabling power to CBIC in which they can assign functions to different officers depending upon territory, class of goods, value, etc., etc. So it seems that all the arguments which were available to taxpayers uh, questioning jurisdiction of DRI that have come to an end. So they need to now fight their battle on merits only. Moving ahead on advanced ruling mechanism under customs law, couple of changes. One, presently under customs law, and in fact that holds true for the GST law also, once an advance ruling has been obtained, it is available or its shelf life is perpetual unless there is a change in law or facts. But now the government has provided a maximum validity of 3 years for each advance ruling which a taxpayer is seeking. So now the law provides that every advance ruling will be valid for a period of 3 years or change of law or facts, whichever is earlier. In our view, a highly regressive move. Advance ruling mechanism is supposed to be an alternate dispute resolution mechanism. And once a taxpayer has come upfront with all its facts, questions of law, etc., then whatever ruling he has got, whether it's favorable or adverse, that should bind both the taxpayer as well as the government till perpetuity. Now, the validity of 3 years raises significant questions. Now, after 3 years, when the taxpayer approaches advance ruling authority, will they be bound by the earlier advance ruling or not? Can they take a different view? What will happen if there is a delay in giving the second advance ruling or not? So there is no valid reason for bringing this amendment, but yes, again, a highly regressive and avoidable move. Moving ahead, uh, uh, we'll say another change for advanced ruling mechanism is that presently, if a taxpayer has filed an advanced ruling application, it can withdraw it within 30 days. Now, the withdrawal time has been extended to any time before pronouncement of ruling. Moving ahead, a very welcome move, even though the details will be spelled out in times to come. So SEZ Act will be replaced. Customs administration of SEZ will be fully IT driven and will function on customs portal only. And these changes are expected to be implemented by September 2022. So government has not laid out what sort of changes will be made, but this can be a game changer, especially for exporters community, if the government can address all their concerns and incentivize special economic zones. Um, Then we have this IGCR in short form, or Customs Import of Duty or at Concessional Rate of Duty Rules 2017, which are effectively end use rules. So certain goods which are imported subject to end use conditions. So a very progressive change. So government has totally overhauled these rules and have made the entire process online. So in a very nutshell, the process is that the taxpayer has to give a prior intimation along with continuity bond to the government, based on which INN is generated. Whenever import of goods take place, the taxpayer has to give reference of INN and continuity bond on the bills of entry. It has to maintain specified records and produce it to a jurisdictional customs officer if required. And lastly, a return has to be filed by 10th of following month. Presently, all these processes were manual. Now everything is automated. So to that extent, it's a welcome move. But yes, in this budget, another disappointment which we felt was that India's foreign trade policy 2015 to 2020 expired on 31st March 2020. It was extended till 21 and thereafter till 22. And with less than 3 months left for the foreign trade policy, the exporters community were expecting some announcements or broad framework of the policy in this budget, which was missing. And this is again something which can provide an impetus to whole exporters community. But as of now, the government is totally silent on what will happen to this. Yeah. So moving ahead to GST proposals. So over to you, Simran.
Thank you, Puneet. Good afternoon, everyone. As Puneet rightly mentioned, that the yesterday's budget was quite contrary to its objective of ease of doing business. The GST law, it was introduced with the objective of free flow of input tax credit. And input tax credit is the essence of GST. However, time and again, government keeps on coming with new conditions to avail ITC. And this budget was no different. By this budget, there are various proposals which have been made, which are likely to make the process of availment of ITC more stringent. So now we'll discuss the existing conditions which are there in the GST law for availment of ITC and the proposed amendments which are to be made for this availment. So starting with the first condition, that is the recipient should receive the goods or services. Second, the recipient should possess a valid document to avail ITC. So not only this, a recipient has to ensure that whatever document, that is the invoice or debit note, which is being possessed by him is furnished by its supplier in its GSTR1, and the same is consequently communicated to him in his GSTR 2B. So this restriction was introduced with effect from January 1, 2022 only. And there was a confusion that whether a taxpayer has to consider GSTR 2A or GSTR 2B to avail ITC. However, while the proposals made in the budget, it has been made amply clear that GSTR 2B is the legal statement to avail ITC, and the taxpayer has to follow that only. Also, while yesterday's budget, one more restriction is proposed to be introduced in the conditions to avail ITC, and that is that the ITC should not be restricted in recipient's GSTR 2B. So, as let us see what are these types of ITCs which are restricted in GSTR 2B. If we see, presently, there are two types of scenarios which are covered under not available category in GSTR 2B. These are one, the ITC which is time bar as per section 16.4. That is where the invoice relates to the past period and the time limit to avail ITC has already been lapsed. And the second case is the place of supply issue. Now, various other restrictions are also being proposed wherein a taxpayer will not be eligible to avail ITC, where that ITC is being reflected in not available field in GSTR 2B. Now, what are these other conditions? First, that the registered person from whom you have taken the supplies, he should file GSTR 1 within prescribed period of taking registration. So this condition is very vague as of now. Rules are expected to be prescribed to exactly to say what exactly is there in this condition. Second, ITC shall be shown in the restricted field where the supplier has defaulted in payment of tax for prescribed continuous period. Again, that that period will be prescribed through the rules. Third, where the tax paid by the supplier in GSTR 1 is less than that, is more than, the tax paid by supplier in GSTR 3B is less than that shown in GSTR 1. Next, again, the ITC of the supplier should not be restricted in his own GSTR 2B. Further, the supplier should have discharged the maximum liability as prescribed under Rule 86P through the electronic credit ledger. And further, the government will also prescribe other types of suppliers which will be covered in this. So from here, we can see that GSTR 2B is likely to be amended very much because as of now, there are no such conditions which are being given there. So we'll see that whatever amendments will be made in GSTR 2B. Also, here the credit of the recipient is being restricted due to the default of the supplier, which is completely incorrect. With regard to this, there is a present condition that a recipient has to ensure that the supplier should pay tax to the government. So if we see these three conditions, 3A, 3B, and 3C, they all deal with the compliances of your supplier. Where your supplier has made any default in his compliances, then your ITC will be restricted. So this is a very unconstitutional change or the existing conditions. And in the past also, there has been jurisprudence where it has been held that the credit of a bona fide recipient cannot be blocked or asked to be reversed, where he has complied with all his duties and there is a default at the end of the supplier.
So Simran, just adding a few points. So you have rightly summarized the whole thing. So if you're so this condition of 3C of payment of tax, this was there in statute book since July 2017. And how GST portal works is that firstly, the supplier files GSTR 1 and then he pays his taxes through GSTR 3B. So if the government has already put the condition of payment of tax, then which is 3C, then actually 3A is not needed because that will presuppose that 3A has been filed. Because under GST regime, how the portal works, tax cannot be paid unless a supplier furnishes his GSTR1. So to that extent, you have rightly said that all these conditions, in fact, the condition of payment of tax itself is unconstitutional, that it cannot take away legitimate credit of a bona fide recipient. Uh, Secondly, whether it was Rule 36(4), which was introduced for this matching, or from January, this uploading of invoices, or from notified date not restricted in GSTR 2B, apart from uh, lack of constitutionality of these changes, uh, this will make the whole compliances at recipients end impossible, because as recipient, I need to ensure he has paid the tax, he has furnished his return, and then in 3B, what has come yesterday, number of conditions that he has made invoices within prescribed period of registration, his credits are being valid or not. So in fact, the whole onus of suppliers compliances is falling on recipients. So, uh, so in my view, to sum up, these are again highly, maybe it may be an extreme word, but these are highly destructive amendments, because it will make compliances more and more difficult for taxpayers. And instead of catching the suppliers, the department finds it easier to catch the recipients by putting this onerous conditions. Yeah, you can continue,
Okay.
Simran. Yeah.
Yeah. So with respect to payment of tax, amendment has also been proposed in section 41, which says that recipient shall be liable to reverse ITC with interest where the supplier has not paid tax, and in case the supplier subsequently pays tax, then the recipient can re-avail the ITC. Now here the question arises that will the time limit to avail ITC apply on such re-availment? In our view, the answer is no, because there is no time limit which is given under the law for re-availment. There is time limit given for availment only. Then the next condition, which is pre-existing, is that the recipient furnishes his GSTR 3B. Then the recipient should make payment within 180 days to the supplier, or in case he fails to make the payment, he has to reverse his ITC. Then the next condition is that he should avail ITC within the time limit given in the law. So from here, we can see that a single recipient has to comply with the multiple conditions which are given under the GST law and are yet to be proposed as well. With respect to time limit also, they have a proposed amendment in section 16(4), which is for time limit to avail ITC. The proposed time limit is earlier of November 30 of succeeding financial year or furnishing of annual return. So this November 30 of succeeding financial year, this was earlier the GSTR 3B of succeeding year's September month. Now they have made one more month available to the recipient to avail ITC. Now, moving forward to the other GST proposals, for declaration of GST credit notes and rectification of details in GSTR 1 and GSTR 3B, it has been proposed that the time limit should be extended till November 30 of succeeding financial year. In the 43rd GST Council meeting, it was stated that the agenda of introducing this amendment is to provide one additional month to the taxpayer to comply with these. The next proposals are with regard to GST return. So the first is the filing of GSTR1 shall be barred if previous GSTR1 is not filed. So this proposal is likely to make suppliers more diligent in filing their GSTR1. The second proposal is with regard to GSTR 3B, that filing of GSTR 3B will be barred if previous month's GSTR 3B or GSTR 1 is not filed. So as of now, there is a provision that filing of GSTR 3B will be barred only if previous month's GSTR 3B is not filed. But now they have added one more restriction by adding GSTR 1 in this. Next is regarding cancellation of registration. As of now, it is stated that the registration of a person shall be cancelled if returns are not furnished for a continuous period of 6 months. But now they have proposed to remove the 6 months limit and they'll prescribe the limit through the rules. Now coming to other proposals in GST, the first one is a very welcoming step. That is, they are proposing to allow transfer of amount available in electronic cash ledger of a registered person within distinct persons. So this will solve the problem of working capital issues within different entities of a single company. So they can easily transfer the tax, interest, penalty, or whatever amount is there in their electronic cash ledger within distinct persons. Second, the relevant date of for refund of zero rated supplies to SCZ has been prescribed as a due date of GSTR 3B. Next is with regard to refunds. As of now, there is a provision for withholding or recovery of refunds, which is limited to input stage refunds only. Now they have extended these provisions to all types of refunds. Next, last and the most important proposed amendment is with respect to retrospective levy of interest at 18% on wrongly availed and utilized ITC. So as of now, there is no interest which is being prescribed for ITC which is wrongly availed and utilized. But with the retrospective levy of interest, the provisions are made more stringent, and this retrospective levy is itself bound to being challenged in the light of Supreme Court judgment in the case of Star India, wherein it was held that interest cannot be levied retrospectively. And the second important thing here is that in the past, the courts have analyzed the term wrongly as which is being due to misrepresentation of facts or suppression of facts. Now under GST, it will be interesting to see that how the courts will interpret this term wrongly. Further, as of now, for interest provisions, the interest for ITC provisions, the interest rate of 24% was prescribed. So many taxpayers would have paid 24% rate of interest on ITC related cases. So once this amendment is being proposed, they can apply for the refund of differential 6% interest paid by them. So this was all about budget 2022. Now we'll be covering the recent changes which have occurred in the past month. So the first one is the GST portal updates. Now onwards, the GST portal will show a pop-up in case there is a variance in liability, that is, there is a difference between liability declared in GSTR 1 and GSTR 3B, or where there is a variance in ITC in GSTR 3B and GSTR 2A. So in these cases, the portal will show a pop-up, and though a taxpayer can tick OK and proceed further, but this pop-up is backed by a legal provision. There is a rule under GST which says that the registration of the taxpayer can be suspended in these circumstances. So it is advised that in these cases, the taxpayers should be ready with the reconciliations in case department comes. Second is a change regarding liability paid percentage. Now the portal will show the liability paid percentage on the portal. So here they will show that whatever GST tax is being paid in 3B and whatever tax is being declared in GST 1. So the variance will be shown by the terms of percentage. So this is merely for reflection purposes. Next is the extension of time limit for applying the duty credit scripts. So the time limit has been extended to February 28, 2022. For MEIS scripts, for the period July 2018 to March 2019, a late cut will be applicable. However, for the further period, no late cut will be available. Similarly, for the SCI scripts, for the period April 18 to March 19, a late cut will be available, and for the further period, no late cut will be available. And the previous date was January 31. Now it has been extended. Next, the change regarding generation of road scripts. So in the last few weeks, the IceGate portal has started generating scrolls white shipping bill on the portal. So from here, the taxpayers can tick on the scroll number and generate the scripts. The scripts can be generated within 1 year of date of generation of scroll. So till the last 1 or 2 weeks, the scroll date was not reflecting on the portal, but now it has started reflecting. And taxpayer should ensure that they are generating the scripts within 1 year of the scroll date. Otherwise, these scripts will be automatically generated. Further, here it is important to highlight that the scripts can be used within the 1 year of their generation, else they will be lapsed. So the taxpayer should ensure that they are timely utilizing these scripts within the given time limit. The next change is regarding a master circular, which is issued by the CBIC for the department, wherein it calls for the formation of a tax recovery cell to expedite the cases where there have been arrears. And for the cases pending before Supreme Court, High Court, or CSTAT, it has been advised to monitor the high success rate cases which involve the arrears of more than rupees 1 crore, and the department has been asked to file applications for early hearing. Secondly, for cases pending before commissioner appeals, the department has been directed to take up the recurring cases and the cases which involve more than 10 lakhs rupees. That's all for the recent changes. Now I'll hand over the session to Puneet to cover the recent rulings.
So coming to the last part of our today's session, a few important rulings which has come up in last 1 month. So starting with Supreme Court ruling in case of Satyam Shivam papers. So this case was dealing with an expired e-way bill, and many of you must be facing these challenges on a regular basis. So the High Court granted relief to the taxpayer. So the Supreme Court rejected the department's SLP. The Supreme Court held that there was no intent to evade payment of tax, so no tax interest penalty should be imposed. Further, very importantly, for raising these frivolous litigations, the Supreme Court imposed cost on the revenue. Moving ahead, Bombay High Court ruling in case of Sire Supply Chain Consulting. So this was a very practical issue which most of you might be dealing. As you're aware that under GST law, the refund application has to be filed within 2 years, but in this case, it could not be filed. And the period from March 2020 to February 2022 falls under Supreme Court extension order. So the Bombay High Court applied Supreme Court order and relaxed the limitation period. In our view, the way Supreme Court order is worded is applicable only for the pending litigations. Filing of a refund claim does not fall under that category, nor statutory provisions or CBIC circular supports that. But yes, the High Court, in its constitutional jurisdiction, is empowered to grant relief based on facts and circumstances. Then the next case is in case of Athi Hotel, which was dealing with transitional credit. In this case, the taxpayer reversed ineligible transitional credit without utilizing it. The Madras High Court upheld imposition of penalty under Section 122. In our view, this ruling is incorrect because as far as transitional credit is concerned, it does not fall, its recovery does not fall within the rigors of GST law, because GST law only has recovery provisions for tax, which is GST, or ITC, which is input tax credit. Transitional credit does not qualify as ITC. So even if transitional credit is wrongly availed, in our view, there is no provision for recovering the basic amount, interest, or penalty. Then before coming to the next ruling, and this is relating to the next ruling only, we conducted a poll that whether ISD registration is mandatory for distribution of ITC on common expenses. So the poll results were 60% of the participants said yes, ISD is mandatory, 37% said no, and 3% were not sure. Now, coming to the ruling, this is triple AR in case of Cummins India. So this is what triple AR has held. Firstly, head office is not entitled to avail ITC on common services where services are received for branch offices. Common services ITC needs to be mandatorily distributed through ISD. As far as support provided by HO for employees is concerned, cross-charge mechanism needs to be adopted. And under second proviso to Rule 28, HO can adopt any value. So in our view, this ruling is incorrect. As far as ISD is concerned, in our view, it's an option which is given. A taxpayer has an option not to go through the ISD route. It can cross-charge even the common expenses, employee support, etc., through cross-charge route itself. And this is supported by the FAQ, which was issued for the banking sector, the draft circular, which was never finalized by GST Council. So to that extent, in our view, this ruling is incorrect and ISD is not mandatory. Then Aristo Bullion, Gujarat Triple AR. In this case, the taxpayer was engaged in multiple businesses. So it utilized ITC relating to first business for discharging GST liability for second business. Advanced ruling authority held that this cross utilization is not possible. Utilization should be done business wise. Uh, uh, when this advanced ruling came, we discussed in our session also this ruling is incorrect. GST law nowhere imposes such restriction that ITC utilization needs to be done business wise. So triple AR has overruled the double AR, and they held that in single registration, ITC can be cross utilized and no nexus needs to be proved. Now coming to the advanced ruling, this commercial credit notes, discounts, etc., especially for consumer facing industries like FMCG, consumer durable, automotive, etc., these are under heightened disputes, investigations, etc. So in this case, the advanced ruling authority held that if the recipient is getting commercial credit notes for discounts, it is not required to reverse ITC. So to that extent, this ruling is correct because there is no GST component on that. But this ruling has also said that recipient needs to ensure that the supplier has not reduced its GST liability while filing its returns. Otherwise, ITC reversal needs to be done. In our view, neither this condition flows from the law, nor for recipient it is practically or commercially possible, whether the supplier has claimed this adjustment or not. So to this extent, the ruling is incorrect. And lastly, it held that as far as these commercial credit notes are concerned, there is no rendition of service from recipient to supplier. It is on account of sale purchase transaction only. And so no GST is separately leviable on these discounts. So thank you everyone for joining in large number. With this, we come to end of today's session. Yeah, take care. Bye.